I'll introduce it, and then Joe will have you do a brief intro. I'm pretty sure I recognize everyone here, but obviously we'll do intros again. So thank you everyone for joining today. The agenda for these meetings are really simple. We start by doing brief kind of protocol updates, key stats, what happened in the last week. And then we'll do a brief intro of, first we'll start with the project intro. Joe and I can do intros, and then I'll intro key protocol stats. So as everyone knows, Joe and I are core members of Sperax USD, a decentralized stablecoin protocol. Sperax is a software development company that builds open sourced financial software, and we deploy it on public blockchains. Sperax USD is our beachhead product. It's an auto yield stablecoin, meaning that the end user, gets to harness the benefits and the power of DeFi and yield farming without having to be an expert. So without having to stake, claim, or do anything really complicated, the end user gets to harness passive income in the form of USDs. So that's actually going to be the topic of today's chat. And I'm Alec, the partner of business development. So I'm mainly tasked with growth, increasing the circulating supply of USDs, and seeing USDs integrated into various DeFi platforms. So that's me. Joe, could you introduce yourself?
It's okay. I'm basically working on the engineering side. So whatever title you want to call me, partner of engineering or something, it's okay. So I basically work on smart contract. So anything technical and detail, I would love to hear. Any question? And here we go.
Cool. So let me just give some brief updates as to what has gone down in the last week and where we are from a growth standpoint. Then we'll get into the AMA questions. So since we talked last, we've had a couple developments. Primarily, we've put in a governance proposal for Saddle's governance community, which is actually going to redirect SPA and SDL incentives from the USDS meta pool, and it'll redirect them to a primary stablecoin pool. So this is beneficial for Sperax because right now we're a meta pool, which is basically like a secondary pool on top of the important pool, which was great when we just wanted to kickstart the growth of USDS, but the pool was so successful that it grew to $30 million in deposits. So we're the second or third largest pool in all of Saddle, and on that, with that motivation, we put in a request to transition from a meta pool to a primary pool. So we'll be paired against USDC and USDT, and the purpose of these pools are for better peg stability, and obviously it's a great farm. Right now it's returning 22% on stable coins, and over $30 million of capital is earning that. So it's incredibly safe, and it's a pretty juicy yield. Okay, so that's Saddle. And then from a growth standpoint, so as I mentioned, we've hit almost 31 million in deposits on the Saddle pool. That's caused nearly 21 million USDS to be minted. And that has caused a net SPA burn of nearly 9 million units of SPA. So that's over 1% of our circulating supply. And as everyone knows, as USDS grows, it causes SPA to actually shrink in circulating supply. So as the protocol matures and gains in adoption, we'll actually have more protocol-owned liquidity, which is our collateral, governed by less units of SPA. So that's the value accrual mechanism. It's really important to wrap your head around that if you're gonna, be hanging out in the Sperax community, because it's our key value driver for SPA. So without further ado, we'll go into AMA questions. Joe, if I missed any updates, feel free to fill the community in now.
Updates. So let me think about it. Yeah, I think that's pretty much it. I guess and engineering-wise, we are working on the VE model, right? The VE star model. And we are discussing the multi-chain design of USDS, right? And also, because one other thing is the rebase. We want to make USDS auto reward compatible with collateral. So when you use USDS as collateral in another DeFi protocol, now you cannot get the auto reward or auto yield. But we already came up with a solution that even if you use USDS as a collateral, you can still get the auto reward. Soup is working on the specification, and I think we're pretty good.
Beautiful, thank you. And I actually realized that I missed a little update. So last week we also got listed on a decentralized exchange. So we're now trading is live on DigiFinex. So pretty stoked on that. You know, we got a new centralized exchange listing each of the last 2 weeks. So hopefully we can keep that momentum up and continue our trajectory. You know, getting more centralized exchange listings and something we haven't made public yet, we're actually finalizing a fiat on-ramp deal. So in the next couple of weeks, we'll be able to see that live and available for customers all over the world. Okay, without further ado, let's hop into the AMA questions. So the first question is, how will you stay competitive with the likes of OUSD and Anchor protocol? You know, why should we hold USDS instead of holding instead of holding OUSD or depositing, say, UST into Anchor? I can take the Anchor one. Maybe Joe, you can discuss the OUSD model a little bit. Is that okay?
Okay.
So from an Anchor side of things, I just want to point out kind of the user experience barriers to entry that are present when having to do something which feels as simple as, you know, capturing yield on UST, but it actually requires, you know, this supposedly new entrant who's interested in capturing stablecoin yield. They have to be able to, you know, go to something like a centralized exchange, purchase an asset, send it over to Terra. So this would be, you know, buying Luna, sending Luna over to the Terra ecosystem, minting UST. Then once you have it minted, you have to send it over to a different website called Anchor. You have to then stake your UST and begin into Anchor and begin earning those rewards. So though the rewards are, you know, lucrative, you're subject to a lot of gas fees in the process, and there's just a massive technical barrier. So we don't believe that actually, you know, most of the depositors in Terra or in Anchor, are newer entrants. So we're actually looking to target, you know, 2 different key markets, one being the DeFi degens with the various farms and liquidity incentives. But for the savings product, it's really going to be a newer entrant. It's going to be someone who's not familiar with these DeFi ecosystems. And what we're going to deliver is an experience that feels a lot more like their traditional bank. So they don't have to be technically savvy enough to, you know, go through those many different steps in order to do something what feels as simple as earning yield on UST through Anchor. It actually is about a 6 to 7 step process, and it deters most regular users from using it. So it's going to be significantly easier for you to capture USDS yield as opposed to, say, depositing UST in Anchor. And then maybe, Joe, you could talk to OUSD a little bit.
Yeah, OUSD. Yeah. So this is OUSD is one of the project we researched before we start building USDS. We mainly look into the rebase mechanism they have. I'm not that familiar with other parts of their protocol because we are not interested. But from my understanding, they are like 100% collateral based. So you basically mint 1 OUSD by 1 DAI or 1 USDC or USDT. So you change one stablecoin to another stablecoin, 1-to-1, to get the auto yield. Well, I mean, I feel like USDS is different from OUSD in the sense that it's not like 100% collateral based. It's like hybrid stablecoin. So partially algorithm, partially collateral. And actually, when you check when you go to the mint page, right? I guess now SPA proportion goes to almost 8%. This actually means a lot. I mean, because this means more USDS are released into the market, more SPA are burned. And as you can see, we have already burned 9 million because of you guys minting USDS, right? So it is a significant price pump for the SPA, long-term wise, I mean. So they see completely different econ model, I'll say. And also it can significantly improve, our model can significantly improve the scalability of the USDS, because later, I mean, we aim to about at least 50% of the asset you need to mint USDS will be SPA only. So in that sense, you only need 50% of the USDC to mint USDS, right? You burn your SPA, and that's easier for the protocol to scale up, because there are just so many USDC and USDT out in the market, right? So if you 100% backed by USDC and USDT, the maximum circulating supply you can get for your stablecoin is at most their amount, right? But because we are hybrid stablecoin, so it can easily scale up, and it will combine the advantage of both like collateral based stablecoin, like DAI, like OUSD, right? And also the advantage of like purely algorithm based stablecoin, like Terra's UST. And also we have two founding member of Terra. Okay. Yeah, I'll just stop here.
Yeah, beautiful. Thank you so much. That's extremely helpful. Next question. So I'm going to skip one because this question is pertaining to what Joe just brought up. So if a bear market is approaching, or if we're already in one, how could a stablecoin project survive? So I'll take this. I think that, Sperax is incredibly well positioned to capture a lot of this demand and ultimately the value from servicing users that are interested in continuing to participate in the crypto ecosystem, but maybe don't want so much exposure to risk assets. So we actually kind of agree with you. We're probably going to enter some sort of sideways market for some short to medium term. So as a result, a lot of traders and a lot of hedge funds are going to be interested in staying in the ecosystem, but selling some of their risky assets. So really, when you're selling shitcoins or selling altcoins, you're only going to sell them into three different possible assets: Bitcoin, Ether, or stablecoins. It's because these are the most trusted and the least volatile. So as you know, USDS has a very unique feature. So as you're not exposing yourself to risky volatile assets, you want to be, hedged off from risk. You're going to be in, let's just say, stable coins. But now you have an alternative that will actually pay you, roughly 10% interest during this time that you're hedging off risk. And anyone who hangs out in the traditional markets, 10% in the TradFi market is a great return. And that's what you can be guaranteed when you're, quote unquote, not exposing yourself to any risk. So we think that people will sell risk assets into stablecoins, and ideally a stablecoin that, delivers more yield without taking on more risk, which is USDS. And then for those that really want to, take bets that say are more volatile and, what might be a project that works well in a bear market, we think Sperax is perfectly positioned to satisfy that user base as well. So what I mean by that is, as Joe mentioned, thanks to the algorithmic component of USDS, as USDS grows in circulating supply, so remember all of these traders and investors and hedge fund managers that are selling their risky assets into majors and into stablecoins, that will cause a corresponding increase in the circulating supply of USDS. As everyone knows, the increase of USDS will cause a decrease in the circulating supply of SPA through the SPA burn. So as these traders store their wealth in USDS, circulating supply of USDS will grow. In theory, the price of SPA should increase consequently from the burning of the circulating supply. So from just a stablecoin earning yield perspective, it's a beautiful product. And once that product is even more adopted, thanks to the auto yield features, it will then cause a significant burn in the SPA. So one could see a price increase from that as well. So that's how you could understand the mechanism, and maybe Sperax is the perfect solution for this bear market. Okay, next question. Sperax works very similarly to Sperax, right? Main difference is that USDS auto yield accrues yields by farming with the SPA collateral. Let me touch on that. So no, Sperax is similar to Frax because it is a fractional reserve stablecoin. So it is a hybrid approach similar to Frax. But we do a couple very different things which are very important. So first off, the yield generated by explicit collateral not being SPA. So this is collateral independent from the Sperax ecosystem. So ours are USDC right now. That collateral is used to generate the yield, and the yield generated, instead of just given to SPA holders, it is actually given to the stablecoin holder in the form of auto yield. So I'm really happy this question was brought up, because Frax will distribute all of the accrued interest to FXS holders and only FXS stakers, actually. Where Sperax USD didn't think that, we didn't think that that really aligned with the ethos of crypto. So the depositors, which are the stablecoin holders, their collateral is the one generating the yield. As a result, we felt it was appropriate to give that yield to the depositors and to the holders of the stablecoin. So kind of similar to Frax, but there are some key differences, including the fact that we give our yield generated to the depositors, not just the shareholders, i.e. the governance token holders. They're compensated other ways. And then Joe, feel free to add anything to that if you wish.
That's a really awesome answer. I love it.
Yeah, cool. We really just believe that, with these systems, a lot of there are ways that we can restructure kind of these cash flows and ensure that incentives are more aligned and looking a little bit less like the traditional banking model, where deposits are used to earn revenue, then revenue is given to shareholders. We're just more attracted to the general mental model of giving the yield generated to the depositors. Okay, anyways, on to the next. Did we set a single target when creating our marketing strategy? No, we didn't. We're pretty global and have been since our product launch. We actually just did an AMA yesterday, Nico and I, to the Korean community. We're listed on Korean exchanges, and we also are obviously extremely present in the US, including having physical offices in New York City. And we host meetups here in the city and, hang out with the community locally. And from a marketing standpoint, no, we target a general global audience, and any sort of assistance that we can get to better tailor content to respective communities, we would really welcome community support on that. Because I'm living here in New York City and I can't exactly see the nuances of what's happening over in Korea. So, insight there would be helpful, and we have grants available for anyone that's willing to help us communicate the benefit of USDS and auto yield to more communities around the world, including, trade or translating, and maybe creating graphics, just stuff that will help us, appeal better to each niche community. Are there any plans to build and own our own swap platform in the near future? We likely won't create our own swap platform. We're really, really big fans of interoperability and creating liquidity pools that are not fragmented. In order to do that, what we'll likely do is integrate multiple different liquidity pools into our front end. So instead of having our own, infrastructure swap platform, what we'll do is be able to enable users through app.sperax.io swap USDs for their favorite cryptos through our front end, but on the back end, the liquidity will actually reside in, say, Uniswap, Saddle, or whichever decentralized or centralized exchange that we're listed on. What kind of event plans do you have to encourage users to hodl? Physical events. Is that what? I don't know if that's what they mean. I mean, encouraging users to hold comes two ways: one from auto yield and two from yield farming incentives primarily. So if you want to research that or ask more questions about either of those, feel free. Next question. So is there an ETA on when we plan to have the auto yield feature go live? Maybe, Joe, we can shed some light on whether or not any rebases have happened and maybe a potential target APY that we're looking at. Maybe also shed some light on when we're going to make that info public.
Yeah, excellent question. I mean, a rebase, or we call it rebase because it's used the rebase technique to distribute the auto yield. Also, I mean, I'll just stick to a rebase. Sorry. So it's been alive on day one actually. So the rebase functionality is always there. On day one when we launch the open beta version of USDS, and we actually have been doing like a couple of rebase already, and we didn't display the data because we wanted to make sure everything works correctly before we publish to our community. And so far, it actually looks pretty good, and we are confident enough to display the data. So the front end team already, so we built a database to monitoring all the rebase related transactions. And we record all the rebase data into a subgraph. And now front end team also finished the integration. So yeah, the auto yield data will be displayed on the DApp page tomorrow. Actually tonight, but let's just give them a little bit more time. I will just be more conservative here, say tomorrow, but actually it will be tonight. So when you click into the app.sperax.io page, right, you go to upper right, there's a TBL. And under TBL, there is total yield distributed. Now it's called generated, which we will change it to total yield distributed. And the latest auto yield APY. These two items now is coming soon. It's coming really soon because it's gonna come out tonight, right? So tonight you will, or tomorrow, you will see all the data. So we target the APY to be about 11%. We actually generate far more than 11%. The thing is, we want to be more conservative at the beginning, and also you never know how the market is going to be in the future, right? So we'd better have some reserve first, and then we can have a stable and 100% transparent mechanism to maintain this APY. I know some protocol, they promise much higher APY, but you need to think about like how they get the yield, right? So, this is just so much APY out there. Ethereum about 5%, Anchor like 12% maybe, but Anchor has anyway. So and also like right. So this is just the numbers there. We don't want to make up numbers. So everything will be transparent, and you will see the data very very soon.
Yeah, thanks so much, Joe. And I'm sure that we'll have we can shed some more light on that with questions as they come. All right. Moving on, is it possible to have a vote escrowed version of USDS for those that would like to stake and participate in governance but don't want to use SPA? Oh, that's interesting. It's not actually in our plan now. In order to participate in governance and capture those rewards, you will have to own SPA. My recommendation would be to stake your USDS in Saddle, collect SPA, stake the SPA into VE SPA, and then boom, you just got free governance power powered by your USDS. But it's a good idea, and we'll keep it in mind as we continue to design the DAO. If the market continues to fall, the USDS auto yield may be more attractive to risk-averse retail investors. This can be a comparative advantage to set us apart from other stablecoins. Any thoughts on this? Yeah, if you had heard my prior comments, like this is exactly how we want to position ourselves. So you get to capture organic yield automatically. So as Joe mentioned, we're not fluffing up this yield with SPA. It's actually, going to be returning double-digit APR without having to subsidize anything with SPA. So, you can capture this yield. You can rely on the yield. You don't have to worry about the yield becoming exhausted as it's organic. And it all happens within one ecosystem. So it's very important you don't have to subject any of your principal to any cross-chain bridges to go get the yields available on Anchor, per se. It all happens within one ecosystem, a very, very trusted ecosystem, the Ethereum ecosystem. So, we're very passionate about capturing this subsection of the market that looks to hedge off some risk and get into stablecoins. We're both secure as well as high yielding. Next question. I want to know what are the current coins that are in the USDS collateral pool, and what percentage of coins are in USDS collateral? Oh, okay. What coins do we currently accept, and what is the current collateral breakdown and composition? Joe, could you tackle this one?
I can take this one. This is actually what we are building. I mean, Daya, one of our engineers, building for the last 2 weeks. So we accept two types of collateral. One is USDC, one is USDT Tether. And USDC is about, from the data he shared with us, it's about like 70 to 80%. So 80% USDC, 20% USDT would be the current composition. And we actually are almost ready about the collateral breakdown, and it will be displayed in our dashboard as well. So you can clearly see a graph, a diagram. So from the day one to now, what the change has been for the composition of collateral.
Thank you, Joe. And we'll give more insight into the collateral breakdown and how it generates yield after this. Actually, I can just touch on it now. I know the question's coming up. So people ask, why the heck do you use stable coins to collateralize another stable coin? Seems kind of redundant and stupid. A couple different reasons. First off, when it comes to security and stability, it might not be the sexiest approach, but we want to go the very safe route. So we're here building on a 10 to 20 year timeline. We're not trying to do anything that is going to be exceptionally risky in the short term to get some sort of maybe short-term price pump or short-term TVL increase. We're looking to basically take the slow and steady approach. And the only way to do that is to have stablecoin collaterals in order to withstand any sort of significant market volatility. So if we accepted Ether from day one and we experienced this, 40 to 50% crash over the last 3 months, our protocol would be significantly underwater today, and we would have some exceptional economic stressors on the protocol. So we elected to use stablecoins from a safety and security standpoint, one. And two, we wanted to deliver a auto yield experience that was appealing from day one. If you look at the yield generating opportunities available, you'll see that USDC and USDT are the most lucrative today. So as we deploy those assets into the curve pool, it allows for the auto yield APR to be very generous for the end user. And just so everyone knows, it is in our immediate plan to begin transitioning away from centralized stablecoin collaterals and into collaterals like Ethereum that can both, provide pretty safe price action. They're not too volatile. Plus, there's very generous yield-bearing strategies available. Plus, Ether is a reliable collateral type, as there's always liquid markets to offload the collateral if you're interested in doing the arbitrage. So we're going to be quickly transitioning out. And then once we go cross-chain, we're actually going to be using collateral types that are most popular in the respective ecosystem. So for Avalanche, we'll be using AVAX. For Polygon, we'll be using Matic, etc., and each of the respective stablecoins in those ecosystems to generate the auto yield.
Yeah, maybe one point to add on is actually we have the module for Ethereum collateral, DAI collateral, wrap Bitcoin collateral ready. So we have the smart contract. So we can launch it whenever we want. The only thing is our econ team takes a more conservative, I would say a more long-term approach on this. We just want to make sure the price pack works perfectly. I mean, also if you think about the market right now, is really volatile. You never know what's gonna happen next day, right? So many things happening in the world right now, right? So we never know. So we just want to be maybe actual cautious, but because we really want to, as Alex say, we will not just stay here, promise a unrealistic APY, have a bunch of acceptable collateral types and make the money and run away, right? That's not what we want to do. We just want to have a really be one of the fundamental blocks of the blockchain industry. We want people to remember us in the long future. So it's at least a 10-year project, right? So we better start with more cautious rather than just be more radical.
Yep. Thank you, Joe. Okay, so the next one is going to be for me. Auto yield is a killer feature. So what use cases will you work on to propose USDS to grow its total value locked? So great question. As you mentioned, auto yield is a very unique feature and it unlocks some really cool experiences for users. So the first one, as Joe mentioned, we're working with perpetual protocols, including GMX and Tracer, to get USDS listed as collateral. So this unlocks a cool experience because as traders are, say, doing a leverage trade on Ether or a leverage trade on Bitcoin over a 1-month duration, their collateral will actually grow in value and help them stay solvent and increase the expected value of their trade just because of the auto yield feature. So if you're looking at two possibilities where option of using USDC or one option of using USDS, one, you'll be given SPA incentives to do USDS, and two, you'll get the auto yield benefit during your trade period. So it's very unique and it's extremely new to traders. So that's the collateral. That's one. Two, we're going to be seeding all major trading pairs on DEXs against USDS. So we're working with tons of different DEX partners to seed major trading pairs and incentivize them with SPA. So we want to allow for USDS holders to swap into any major asset in the Ethereum ecosystem starting, and then ultimately in each respective ecosystem. But the requirement there would be to seed trading pairs against USDS. And then ultimately we're launching a product. So powered by USDS's auto yield, users will easily be able to acquire USDS with a fiat on-ramp and then simply watch their balance grow through a passive saving experience. This might be comparable to an Anchor type product. So those are the three major ways in which we will see USDS TVL grow. And then we're always open to proposals from other DeFi protocols and projects interested in integrating USDS. We're here to support engineering as well as economic incentives through SPA. So don't hesitate to reach out and help us grow this TVL. Okay, next question. As the collateralization changes to draw a greater percent from SPA and decreasing other collaterals, there will be less collateral to create yield. So over time, do we expect the APR to decrease as the need for collateral decreases? And do you see this as a big problem for the growth, as it will basically take away from the auto yield, which looks to be our killer product or our killer feature? So are there other ways to supplement this yield? And then, could we consider compounding a percent of the yield instead of paying it all out to create a growing base? I have a couple ideas on this, but maybe Joe, do you want to start on it?
Yep.
What do you think?
Yeah, it's a good question. I mean, so yeah, it's my concern initially too. I mean, but actually, it's not a concern because first of all, when you have more liquidity, when you have more capital, it's just much easier for you to get a higher APY, right? You can leverage your capital. And also, we are coming about with the better strategy we have now, just simple staking curve. Now, then later on, when we have a larger capital, we will convert some of them to VE CRV to boost our yield. So it will be doubled or tripled of the APY, so to speak. But we will maintain a stable APY. And the rest of it will go to the reserve, and we will think how to make the best out of it for our community. So I think long-term wise, no need to worry. As USDS ecosystem goes to bigger, the capital goes to larger. It's just easier for. I mean, there's a principle, I guess, in economics that the rich people can. It's basically easier for them to make money, right? That's the world we live in. Sorry, right? So I guess when the SPA percentage goes down, and this actually in turn will result in a higher price of SPA, and this means we have more capital in our treasury, right? And also, one thing really worth noticing is actually as a SPA holder, you can participate in to decide which direction this SPA token in the treasury gonna go. So definitely pay attention to our VSPA and the DAO afterwards, because you can be part of the decision.
Thank you. Next question. So the Alchemist is mentioning that he sees a great use case in self-paying loans, similar to Alchemics, and this is really interesting. So I love this use case, and we're thinking a lot about it. So we actually wouldn't have the loan balance decreasing over time. So Alchemics basically fronts you the loan, and then you're using your collateral to close out the outstanding debt. Where what Sperax will do is actually just lower the debt burden, but it's up to the end user to repay back the loan at on the schedule that they wish. So what I mean by that is if you're borrowing USDS versus USDC against Bitcoin, you have a couple different options, right? So you can take out the loan and you can borrow USDC, but USDC doesn't earn any auto yield generation. So what you have to do is you have to go put that USDC to work. And you can do that. You'll be required to pay gas fees, and it'll be ultimately up to you as the end user to deal with the emotional stress and the technological burden of going and capturing that yield. Where if you were to take the loan in USDS, you earn a native yield automatically, and it's actually going to be a boosted yield compared to the other safe options like CRV and the curve strategy, because we actually conduct the curve strategy, but distribute it over significantly less units of stablecoins. So the APR will be higher than if you were to just use the USD to deposit it into curve just by itself. So we do envision, this idea of like having an interest-bearing being really popular, but we don't have necessarily like a in-house product for it yet. We're actually talking with the Vesta team to do looping and some various other cool strategies, which would include lines of credit with interest-bearing strategies. And sorry about the background noise. I don't know what's going on in our office right now. So if you hear some people like hollering, I don't know what's going on. Anyways, next question. Will the auto yield rates be affected by what chain we're on? The effective rate will change, but we haven't decided exactly how excess reserves will be. Excuse my background noise. So say like USDS is returning on Avalanche, we may grab the 20% over the 10% target and then keep that in reserves for future APRs. But we're still figuring out that cross-chain design.
Yeah, actually, it's a really good question. I mean, we haven't have the answer yet. So if you have any suggestion, or any of you have any suggestion, we are really willing to hear. Because it's a problem we are thinking about it for already for like 3 weeks. We have some initial thoughts, and we are brainstorming every other 2 or 3 days. Yeah, one of the key point is, this exactly this point is how you distribute the auto yield to people in different blockchain, right? There's some overhead when you do cross-chain transfer, first of all. Second, each ecosystem, say Avalanche versus Ethereum, they have different, I would say, benchmark APY, right? How to balance. You don't want to incentivize one ecosystem too much, right? Solana people, Ethereum people, they are like kind of hate each other. So how to balance each ecosystem? That's a good question. If you have any suggestion, we're really willing to hear.
All right, thanks for wrapping that one up. All right, next question. What makes our stablecoin special? Auto yield, baby. We've already talked about it a lot. And obviously the ability for it to like be responsive to price action, plenty of other capital efficiency benefits, but we can get into that later. Auto yield is the main killer product for the average user. How do you optimize and amplify investors? So we don't do any sort of amplifying or compounding simply because that encourages dumping, and we don't encourage dumping. We encourage locking and long-term holding. So we don't have any listing or partnerships with auto compounders because we don't like dumping to begin with. So we obviously won't compound the dumping. Okay, so with DAO governance, could SPA holders vote to increase the new collateral investment to improve auto yield APR? Yeah, absolutely. So the collateral composition ratio, the collateral types, and the collateral deployment strategies will all be determined via staked SPA holders. Is there any way to freeze USDS? No, so USDS operates, and we're not a centralized project like Tether. So, not only our reserves, but all of the code is completely on-chain and everyone can go review it. So there's a question around liquidity incentives. So it's talking about new projects fail to have adequate incentives. If you've been following our project, we have quite a lot of new, really exciting farms on Uniswap v3, and we're the first team to launch a Uniswap v3 farm, actually. So there's stuff for all types of different investors, including stablecoin yield farming rewards with fixed APR. We have USD yes, SPA pools. We have just SPA pools. We've got all sorts of incentives for stablecoins as well as SPA. And we'll continue to roll out more farms with more partners. But in the meantime, if you want to farm some SPA with stablecoins, go head over to Saddle. Or head over to app.sperax.io/incentive farms live today. Are there any money markets where we can borrow USDs for higher yields? Not yet, but very, very soon there will be. So that's some alpha for you, but not yet. So Intrepid User is asking a question about TVL, and they're proposing this problem, which is a great problem, but it's a problem in the event that we're so successful that we have so much TVL that we kill our own APR rates because having too much collateral earning yield. So, Joe, do you want to answer this one?
I don't really quite get the question. So he or she is saying when we have too much collateral.
Yeah, I guess the situation would be, say, hypothetically, we have $10 billion worth of USDC or USDT. We wouldn't have enough. There wouldn't be enough opportunities available to generate yield. But I mean, realistically, this will be mitigated as we diversify collateral types and go cross-chain. But feel free to weigh in.
I mean, if we ever, encounter this problem, I'll be so happy. I'm like, okay, yeah, there's just that we are so big that the ecosystem cannot have us, right? There's just no place to handle this huge collateral, and then we're gonna be super successful, right? I'm looking forward to that day. That'll be a really happy trouble to have, I would say. So no need to worry.
Yeah, agreed. And then the other questions by Intrepid User had to do with cross-chain deployment and correct. The deployment on each respective chain will have its own respective deployment strategies and respective APR. Do you foresee entering into any custom yield opportunities? TVL is large enough. Yeah, so ultimately this is going to be the role of the VESPA holders. We do envision them basically managing this on-chain money market fund with the objective of optimizing for risk-adjusted returns of the collateral. So most of the time that will consist of blue chip products with the most TVL for the longest period of time, just because it's the safest. So though we might be able to get incrementally higher APY in a different ecosystem, it's not worth the risk of potentially getting rug pulled for 10% of our collateral. So though it will ultimately be, SPA holders that will decide, most likely the ethos of the community will encourage to optimize for risk aversion for a little bit lower APY, but ensuring that we don't get rug pulled. So I hope that answers the question. How does USDS compete with DeFi yields? It doesn't. It automates them so it can democratize them and give those yields to anyone that has an internet connection. Looking at the auto compound feature, right now, it doesn't go to LP tokens. So the question is, will it go to LP tokens? And the answer is eventually yes, but we're still working with the most efficient way to distribute yield to USDS in smart contracts. So stay tuned. We'll update the strategy and the plan for that and let the community know when and which smart contracts will be able to accrue auto yield.
Oh, I can bring some updates. So we already finalized on a solution internally, and it's a short-term solution, but in the sense that it's can work for a year. We call it short-term because it doesn't require a redesign of USDS. It's mostly like you adjust, you add something upon the existing protocol. We call it adjustment, so we call it short-term because ideally you want everything to be inherently supporting this new feature about having USDS auto yield for collateral, right? So when you stake your USDS as a collateral to another smart contract or etc., you can still get the auto yield. Ideally, it's a redesign of USDS so that it can smoothly natively support this feature. But that takes time, guys. It's not easy. But we already come up with a solution that is a adjustment of the current mechanism, and it has been finalized. And our product manager, Soup, he's finalizing on the specification. So we will start working on that after we launch the spot. So definitely looking forward to it.
Cool. So Panzer says that we're trying to create more use cases for USDS. Can you tell us what will entice people to switch from existing ones? So we talked a lot about that. It's primarily the auto yield APR and how easy it is to get that APR. So for exchanges and various things like that, it's just holding the asset, and then for the average user, it would be as simple as just connecting via bank account, credit card purchase, or swapping their Ether for USDS and then earning the auto yield. How is the auto yield being paid? There is no inflation, as I mentioned before. It is an automated curve LP strategy today, and we will be adding more deployment strategies to optimize for risk-adjusted return. How can, is the vision to compete with Tether and USDC? Conceptually, yes, but I don't think they're really competitors. They use a radically different model, one that includes a lot of trust and regulation, where ours is completely on-chain, trustless, and targeted more toward users that respect and appreciate those attributes.
Yeah, and
okay.
Also, someone has a question here. Someone just raised their hand.
Yeah, for sure. I'm not looking at the AMA channel, so let's Sam up here for sure.
Because I don't know how to bring them up to the stage.
Hey guys, can you hear me?
Yeah.
Yes, sir.
Perfectly.
Awesome. Yeah, I just had a question. So I guess one of the main draws of a fractionally algorithmic or fully algorithmic stablecoin in theory should be it's capital efficient and therefore cheaper to borrow. But if the inherent yield on USDS is 10%, let's say, don't you think the borrowing cost would naturally gravitate towards that? And how do you guys think about that, I guess, longer term?
I can speak on that real fast. So first off, the important thing to note, we have to separate altcoin that doesn't use CDP. We have to look at protocol owned liquidity.
SPA is because it's a USDS is partially collateralized, right? So there's a borrow question. I mean, can you just explain more? I mean, I'm from engineering. I don't really.
Yeah, I can hear you all right. I guess I'm just saying, if you borrow USDS at 1%, and then you can just hold it and earn 10%, then I could just borrow as much as I possibly could just to get the spread. So wouldn't naturally the borrowing costs gravitate towards 10%?
Oh yeah, I think that's exactly what we wanna. I mean, that's exactly how we pitch to lending protocols. I mean, say we talk to them, hey, if you use USDS as collateral, I mean, the borrower, they are incentivized to borrow because they have the auto yield, which just to pay for their interest, right? Yeah, so I'll say in that case, we actually have a discussion last week about because we can decide whether we want to prioritize the lender or the borrower. So we can, because say lender, they send USDS to the smart contract, say Aave, and Aave and the borrower get the USDS from Aave, right? So how, because there's only this amount of USDS, the question would be how you split the USDS auto yield between the lender and the borrower, right? This is something we can decide. Actually, it depends on, first of all, what the community wants. Second, what our partners, I mean, say Aave, Compound, what they want, and what's the easiest way with less likely to have a bug there, right? So yeah, this is something actually still out there. It's flexible, but definitely it's incentive for both the borrower and the lender. I mean, we will have to balance the two parties.
Okay, yeah,
Sorry,
that makes a lot of sense.
Yeah. Yeah, it's a really good question. I mean, I guess you understand every detail of USDS. By the
Trying
way,
to.
you want to ask this question? Yeah, I'm really appreciate it.
There's something worth considering though. So like from a capital efficiency perspective, we have to like separate out like minting a stable coin versus borrowing it, right? Like
That's true. Yeah.
so to get to get DAI, there's two different ways to get DAI, right? You either mint it or you borrow it. Minting it requires a bunch of stable coin or a bunch of collateral, and it's actually requires like a bunch of over collateralization, but you still own the collateral. So you know if you wanna mint DAI, it's probably because you want to lever up on your underlying collateral or short some other position, right? So it's
True.
people that mint the stable coin because they want to do a trade, where this is very different than like a USDS. Like the capital efficiency, I've just never liked that argument because it's like, hey, you know, we use less collateral, but it's like a totally radically different use case. So beyond that, if a user were to want to borrow USDS, what we would do and the vaults that we're building would be that you would actually mint Vesta or any sort, or maybe a Fei token, you know, at 0.5% interest. So you can lock in your interest rate. You don't actually have to subject yourself to the market rate. And then you would instantly swap for USDS. So you deposit whatever collateral you would deposit anyway, but instead of borrowing USDS straight up, which may charge you a high rate because of the auto yield, you know, you can actually mint at a artificial rate, being 0.5% on, say, Vesta, and then you instantly swap that asset for USDS. So now your loan is accruing interest at 0.5%, but your asset is accruing interest at 11%. Does that make sense? So like it wouldn't be economically reasonable to borrow the USDS itself.
Yeah, that makes total sense actually. Joe, like kind of like got my brain turning though. You could do some interesting stuff like based on the utilization rate of a certain pool if you did want to decide whether to incentivize borrowers or lenders of USDS, but it sounds like you're going more the route of borrow other collateral types, mint USDS, and then capture the yield there. But yeah, a lot of cool ideas.
Yeah, I mean, we definitely want to incentivize people to mint the USDS, right? It's better for us as a team and also for the community, right? Because more USDS means more spot burn, means spot price goes up, right? So yeah, but let's see how it goes. I mean, yeah, I guess usually people just incentivize or like more favors go to the borrower. But let's see what would be the balance there.
Awesome, thanks. I just have one more question too. I didn't know if you guys saw Zigzag on ZK Sync yesterday. They like decided they're going to switch over all their USDC, USDT pools over to UST. I didn't know if there had been any talks with them because it seems like they're interested in moving away from the centralized stablecoins.
We haven't talked with them directly yet. Couple challenges. You know, first we're not on ZK Sync yet, so we really want to do what they're doing. You know, it just makes a lot of sense. We are a decentralized stablecoin protocol, and we should be servicing all the decentralized exchanges. So that's, you know, our objective. No, we're not talking with Zigzag directly. And from what I've heard, you know, a lot of these protocols that are integrating UST are getting massive grants. So we're going to have to, you know, deal with the uphill battle of that. So we're not talking with them directly yet.
Okay.
Hey, I think I have to go for a meeting. So I guess is there any other question you want me to answer?
Nope, I'm all good. Thank you guys so much.
Okay. Oh, Alex,
For sure.
do you have any questions?
I'm going to stick around for 5 minutes. No, you're all good. You're all good, Joe. Thank you.
Okay, cool. Thank you, everyone.
Peace.
Nice to be here.
Alrighty, just me. So I got another couple minutes here. I'll try to knock out a couple more. Can we get more aggressive with the collateral ratio? Peg is strong. I agree. We're gonna stay with the current collateral. What's the word? We're gonna keep the current rate, which is 1% per month, for the foreseeable future, at least until we transition to a on-chain governance model, because we don't want to be making these decisions internally at Sperax. We want to keep it public, transparent. So, the model is right now it goes down by 1% per month. So we're going to stick with that until we're on full chain governance. How does Sperax cause token liquidity? How does it solve that? Just go check out our farms. We got a crap load of liquidity. We got 30 million in the saddle farms, 10 million in Uniswap, plus more elsewhere. Liquidity is not an issue. How is the SPA minted? You deposit USDC plus a small percentage of SPA, which will be burned. That composition or breakdown is determined via the on-chain ratio called the Chi ratio. Next question is, how is the USDS rebased to users? The protocol collects trading fees from the LP positions plus the CRV rewards from Curve. And then it sells the CRV as well as the accrued fees, sells them for USDS, and then the USDS is given to the holders. So there's no inflation from SPA. This user, Alex, is asking if they deposit 100 USDS as collateral, you withdraw 100 in a year's time. I don't know what this is asking. You don't deposit less. Auto yield gives you more money. So I'm not really sure what you're asking, Alex. Feel free to clarify if you want. Akira Trump, talking about the ease of use for stablecoins. Yeah, we're trying to deliver, savings experience products. So through fiat on-ramps and an exceptional user experience, we plan on delivering stablecoin yield to the most nascent and novice cryptocurrency user. Okay, final 3 questions. We would love to see SPA and USDS on the Cadena ecosystem. Yeah. So we start with projects that are on mainnet first. I can't even have a conversation with a team that's not on mainnet. I don't know how we would work together if they're not online yet. So, once they're online, heck yeah, we're interested in seeing USDS go cross-chain. And we would love to get them in the cross-chain deployment team. So if someone wants to make an intro there or give me more info on kind of when they're live, that'd be awesome. But right now we're prioritizing Near, Avalanche, and Polygon. Any alpha on the Sperax blockchain? That'll be later this year. Once we prove product market fit, we'll be launching modular ecosystems in order to service our most passionate users and deliver an experience that feels like Venmo, but all powered via crypto. Yeah, so question 3, any thoughts on building an Anchor protocol style product? And that's going to be the Sperax Earn, a Sperax Save. It's going to be powered by auto yield, but through the help of fiat on-ramps, it'll be just like the Anchor protocol, except we believe there's going to be some cool security benefits available for hours compared to Anchor. Alrighty. Those are all of the community questions. Thank you, everyone. Feel free to raise your hand right now if you'd like to hang out or ask any questions on stage. I'll stick around for a few more minutes. Well, all right, everyone. Thank you so much for joining the weekly AMA. This one was pretty long. We'll be back next week, same time, 12 p.m. Eastern, to answer all community questions and just give you all some updates and just to check in. So with that, no more questions. Have a great day, everyone. Thank you so much for joining. I'll see you next week.